So I've been getting a lot of requests asking me to do more educational videos on the channel. And so today we're going to start off a brand new playlist that I'm calling Stock Market for Beginners in 2019. And you can find that playlist on the channel or in the description below. But today we'll start things off with a beginner's guide to stocks in 2019. So in this video, we're going to cover all the basics of stocks, what stocks are, how they work, how the stock market works. We'll also talk about dividends, and we'll talk about how to actually buy stocks and how to actually find stocks and value stocks and see if they're cheap or if they're overvalued. We're going to cover all of that in today's video. I hope you guys enjoy it. Let's go ahead and get started. What's up everybody, my name is Ala and welcome to my world of stocks. So we're going to break down today's video into 4 different parts. It's all going to be in this video, but we're going to have different sections in the video. And so part 1 will be what stocks are and how the stock market works. Then we'll transition to part 2, and that will be covering dividends. So I'll kind of just quickly explain dividends. And then in part 3, I'll teach you how to actually look for stocks and how to see if they're undervalued or overvalued, just kind of the basics. And then in part 4, I will end the video teaching you how to actually buy and sell stocks and what you actually have to do in order to be able to do that. I know that this is going to be a lot of information, but you got to just trust me, it gets easier over time. This video is very beginner friendly. So if you're already buying and selling stocks, you're probably not going to get a lot of value out of this video. But if you're a beginner, I think you're definitely in the right place. And I'm also going to leave timestamps for you down in the comment section on a pinned comment. So in case you need to rewatch this video to see something again and just kind of let it all sink in, you can come back and you can go to the specific part of the video that you need. So I'll have timestamps for the different parts in the video. All I ask in return is that if you enjoy this video, please support the channel just by hitting the like button or by sharing this video with any friends or family that might be beginners in the stock market and want to learn about stocks. Okay guys, but starting with part 1, we're going to talk about what stocks are and how the stock market works. Now the stock market is also referred to as an equity market. So in the trading world, stocks and equities are basically the same thing, and they both refer to ownership. In other words, the stock market is just a place where you can buy or sell the ownership of a company. And so this allows tiny and very insignificant people like you and me to become part owners of giant corporations like Amazon, Google, Microsoft, Disney, and so on. Now you might be wondering, well, where is this magical place or this market where we can actually buy and sell ownerships of companies? Well, the term stock market can be used very broadly and even in a plural form, like when we say things like the markets are performing poorly right now. But in general, it's used to talk about stock exchanges like the Shanghai Stock Exchange in China or the New York Stock Exchange, which is famously located in New York City. But the cool thing is that you don't have to actually go to any specific place in order to buy or sell stocks. You can just simply sign up for a brokerage account that will give you access to stocks, and I'll explain how to do that at the end of the video. But first, let's break down stocks a little further. Now, stocks are known as ownership certificates that give you a certain amount of shares of a company. Now, the terms stock and share often get used interchangeably, but the most important or the most common way that you would use them would be to say something like, hey Ale, I heard Microsoft stock is priced at around $100 per share. How much do you own? And then I would reply saying something like, well, Matthew, I currently own 10 shares of Microsoft stock that is worth $1,000 in total, because 10 shares priced at $100 each equals $1,000 in stock that I own in Microsoft. Now, stocks can either go up or they can go down based on how much demand there is in the market for that specific stock. In other words, if Microsoft as a company is performing well, then more people are going to want to own that company, which means they're going to compete for purchasing the stock, which drives up demand, and ultimately that drives up the price of the stock per share. Alternatively, Microsoft may report some weak performance, maybe during one of their quarterly earnings, and so people may feel that the stock is priced too high, so they might actually sell the stock, and if there are less buyers than there are sellers, that means that demand for the stock has dropped and the share price of that stock will drop right along with it. So to give you a quick example, if you own one share of Microsoft that is priced at $100 and the stock price goes up by 50% because of high demand for that stock, then the share price would now be $150 per share. So at that point, you may decide to sell the stock and take the $50 in profit that you just made on that stock. Alternatively, that same stock could go down 50% because of low demand for the stock, and so the price would now be $50 instead of $100. And so at that point, you may choose to actually sell the stock, and if you did, you would lose $50 on your investment because you bought at $100 and you sold at $50. Of course, this is why many people stick to long-term investing, because in the long term, good companies tend to recover and perform better over time, which means that your stock's value should also recover as long as the company is being led by good management and is reliable in the long run. Another advantage to long-term investing is that it makes it a lot easier to drown out any short-term noise or volatility, because you believe that many years from now, this company will be much bigger and the stock's value will reflect that in a positive way. I personally stick to long-term investing myself for most of my stock market investing, although I do sometimes make short-term adjustments when necessary. Okay guys, now moving on to part 2, we're going to talk about dividends. Now I just want to quickly explain what dividends are and how they work, because they can actually be a very reliable source of passive income when they are used correctly. Now there's actually a few different types of dividends, but today I'll be talking about cash dividends, which are essentially a cash payment that is made to shareholders by the company as a way of rewarding them for investing in that company and as a way of sharing the company's profits with its shareholding owners. And these payments are usually done quarterly, but can also be made yearly and even monthly, depending on the structure that the company uses. Now, if you're wondering whether a stock that you're interested in pays dividends, one quick way to find out is to use one of my favorite websites, which is called seekingalpha.com. And for this example, we'll use Google, and we'll just Google search Microsoft stock Seeking Alpha. And then we click on the first link there, and then we click on the dividends tab, and from there we get all kinds of different sub-tabs with lots of different information on their dividends. But to keep this video short, we're just going to quickly analyze their dividend scorecard and their dividend summary. Here we see that the dividend yield is at 1.83%. That means that for every share you buy at this current price of $101.18, you'll get back 1.83% of your investment in the form of a dividend on the next payout date. Then we have the annual payout, and that's the total monetary value that they're paying out per share, which is used to calculate the yield that we just talked about. Then you have the payout ratio, and that's the percentage of their earnings that the company is paying out in dividends. In general, a low payout ratio can mean that the dividend has more room to grow and is therefore sustainable. But companies that pay very large dividends usually have much higher payout ratios, so it just depends on what it is that you're looking for in your dividend stock. Next is the 5-year growth rate, which is just telling us what the average percentage is for every time that they increase those dividends annually for the past 5 years. So higher growth rates can sometimes be very attractive to investors. And then finally, we see the dividend growth of 15 years, and that just means that they've increased their dividends every single year for the past 15 years. So if that number is high, then that means that management is likely very committed to increasing those dividends, which means that they're much more reliable and that that they're probably also very attractive to dividend investors because of that reliable history. Okay guys, now we're going to move on to part 3. And here is where we're going to talk about how to actually find stocks to invest in and how to value stocks and determine if the stock is cheap or if it's too expensive. Now, first, I have to give you a quick disclaimer that every investor has a different method for valuing stocks, and either way, all of the different metrics and the things that we're going to talk about today are just tiny little pieces of the overall giant puzzle, but this is a great place to start. Now, step 1 is to stick to an industry or a market or a sector that you actually understand. In other words, if you play a lot of video games, then you want to look for video game stocks. If you are very into building personal computers, then you want to maybe stick to semiconductor stocks. If you're really into fashion and makeup, then you might want to look at those kind of stocks or those kind of companies. If you're really into social media, then you might want to look into Facebook, Google. You might be really into cars, so then you can look at, Ford, Tesla, automakers. You can also look at auto part retailers. So just kind of sticking to a market that you understand. And the reason why is because if you stick to companies that sell a product that you might be using yourself or that you're interested in and that you're just kind of casually researching maybe just as a hobby, then you're going to be much more likely to understand the company and their business and how they're performing and how they're doing in terms of the products that they're selling and what they need to do to perform better in the future. So it's just going to make it much easier in the long run to be able to understand this company and their business. Okay, now step 2 is to start looking at the financials of the company and maybe looking at some of their metrics and valuations to see if that stock is actually, cheap or if it's very expensive. Now, there's many different things that you need to look at, and we would of course need to look at the income statement and the balance sheet, but I'm going to cover those in a separate video because I'd have to go really in depth to really cover those. So today we'll just kind of take a beginner-friendly approach, and I'll just cover some very beginner-friendly metrics that I think are a good place to start. Okay, now the first metric that we'll look at is the PE ratio. You've probably heard a lot of analysts bring up this ratio, and all it is that it's the price to earnings ratio. So it gives you an idea of how expensive the stock is relative to how good its earnings are. And it's calculated by taking the price per share of a stock and dividing that by the earnings per share of the company, which is also known as the EPS. Now, the lower that this PE ratio is, the cheaper that the stock is generally considered. But you really have to be careful here, and it's going to take you some time until you can really be able to understand what a good PE ratio is, because you also have to look at the industry's PE ratio, like average PE ratio. You got to look at its competitors. It's going to vary by different industries and different companies because they operate in different ways. So it's just going to take some time, but I recommend looking at the industry's average PE ratio of where that company operates in and looking at some of its biggest competitors. And then that way you just kind of get a good feeling of whether its PE ratio is maybe a little bit too high or maybe it's a little low and the stock is undervalued. However, just kind of in the general sense, a lower PE ratio is usually what attracts value investors because that might mean that the stock is undervalued or the company is undervalued. And then higher PE ratios generally attract growth investors because there's a reason why they're paying more now, because they're paying more now for future earnings, right? For future growth. So something like Amazon obviously has a very high PE ratio, but it's because they have a very bright future, and a lot of investors believe in the company long term, so they're willing to pay a premium, which drives up that PE ratio. And that brings us to our second metric, which is the PEG ratio, which factors in future growth. It's basically price to earnings to growth. And so even though that a stock may have a high PE ratio, its PEG ratio may actually be lower because it's expected to have a lot of growth in the future. Now, in general, a PEG ratio that is lower than 1 may be considered undervalued based on future growth, while a PEG ratio that is higher than 1 may indicate that the stock is a little expensive and you may want to proceed with a little bit of caution. And that's especially true if that PEG ratio is as high as like 2, 3, 4, etc. You definitely want to do some research and figure out why that future growth is expected to be so poor in relation to the current price that it's trading at. Okay, now you might be wondering, well, what if a company isn't profitable yet and thus doesn't have a PE ratio because they have negative earnings? Well, in that case, you can look at the PS ratio, which is the price to sales ratio. In other words, instead of using earnings as the denominator, we are now using revenue because the company will always be making revenue, or at least assumedly always be making revenue, but may not be making positive earnings. So then the PS ratio can help us understand if the company is performing well, at least from a revenue standpoint. And just as before, the lower that the PS ratio is, the cheaper that the stock is generally considered versus their competitors. But again, if this is a company that is not profitable, then you have to wonder how much of a value it can even be, considering that, it's not even making positive earnings. So you just got to proceed with a lot of caution when using the PS ratio. Okay, and lastly, we'll just look at what the PB ratio is, which tells us what the price to book ratio is. And to do this, we just divide the price per share by the stockholder's equity per share. In other words, we take the difference between a company's assets and liabilities per share and then divide that into the price per share. And theoretically, this helps us understand if we are getting a lot of the company's net assets for the price that we're paying. In general, a PB ratio of less than 1 is generally considered a good value because the price is less than the company's net assets, but a ratio higher than 1 starts to raise some concerns depending on the situation and how high that PB ratio is. Now, if you want to find any of these ratios in just kind of a quick and easy way, I recommend going to yahoofinance.com, searching a stock, and then clicking on the statistics tab where most of these metrics should pop up. Just keep in mind that different websites calculate a lot of these metrics differently, so you may want to look at several sites before making any kind of judgments, but Yahoo Finance is just kind of a good place to get an overall view of some of these different metrics in a very beginner friendly way. Okay guys, and that leads us to part number 4. This is the last part of the video. Thank you for hanging in there. You're doing a great job. This is gonna get easier over time. You just gotta trust me. You know, when I first started, it was a lot of information to take in, but it gets easier over time. Now, in part 4, we're going to now talk about how to actually buy and sell stocks using a brokerage account. Now, these are essentially financial accounts that are maintained by brokerage firms. And examples of brokerage firms would be things like E-Trade, Fidelity, Charles Schwab, etc. But my personal favorite broker to use for beginners is Robinhood and also M1 Finance, but I'll explain why in just a second. Now, brokerage accounts give you everything you need to buy and sell stocks, and they are very easy to use. You basically link your checking or savings account to your brokerage account, and that way you can use money from your bank account to buy stocks. Now, brokerage accounts are usually free to sign up for, but then they usually charge you a commission fee every time that you want to buy or sell stocks. And those fees can range from like $3 to $7 in most cases. But those fees are charged per order, per transaction, not per actual share. So in other words, let me just give you an example. If you were to buy 100 shares of Disney and the commission fee is $5, then you're going to get charged $5 for that order of 100 shares. For that entire order, you're just going to get charged $5. It's not going to be $5 per share, right? It's not going to be 5 times 100. It's just going to be $5 for that entire order. But if you buy 100 shares of Disney, maybe you buy 100 shares of Microsoft and then 100 shares of Amazon, which by the way would be an enormous amount of money. But if you were to make those 3 different transactions, then yeah, you're going to pay $5 here, $5 here, $5 here. Or if maybe you want to buy maybe 10 shares of Disney, but maybe you buy them at different times, like you buy 1 share and then 1 share and then 1 share and then 1 share, at different times, you're going to get charged $5 every single time. So you can start to see how these commission fees can really add up and can really eat away at your profits, especially if you're someone like me who likes to buy small amounts of shares whenever you have extra money in your budget. Like whenever I have some extra money in my overall budget, if I'm not putting it into a cash position or if I'm not just saving it, then a lot of times I'll just kind of keep investing in stocks. And a lot of times I like to buy, just kind of small amounts of stocks whenever I have that extra money. So if I'm doing that often, I'm going to start to pay a lot of money in commission fees. And that's what I used to do because I used to use E-Trade a lot. But now I've really switched to mostly using Robinhood. Now, I'm not sponsored by Robinhood in any way. They don't pay me any money, at least not at this moment. But I like using them because they don't have any commission fees for any kind of, buying, selling stocks, no commission fees. And then there's also M1 Finance, which is also getting pretty popular right now. And they have fractional shares from what I've heard. So if you want to buy like Amazon and Amazon is trading at like $1,500, you can buy fractional pieces of Amazon for much lower prices. So it's just kind of, it makes it like more accessible to you if you don't have as much money. But I've never used M1 Finance, so I can't really recommend it because I've just never used it. But I personally use Robinhood, and it's very easy to use. All you got to do is just download the application to your smartphone, and then you just link your bank account to your Robinhood account, and then you can just basically buy and sell stocks. And again, it's commission free, so you're just paying the value of the stock. Okay guys, so that's gonna wrap it up here for this video. If you have any questions, if anything doesn't make sense, leave your questions down below. I will do my best to answer all of them. If you're confused on how to use Robinhood, leave me a question. I'll do my best to answer it if you want to learn about different order types and things like that. But I'm gonna make more educational videos and they're gonna go to that playlist. So make sure that maybe you want to bookmark that playlist or just subscribe to the channel, and and you can see whenever I post a new video. But I mostly just post videos on different stocks, and I review stocks, and it's just a lot of fun. So you might want to consider subscribing. Also, if you enjoyed this video, please do me that huge favor of hitting the like button and maybe sharing this video with any friends or family that may benefit from this. But thank you so much for watching, guys. I really hope you enjoyed this. Again, watch this video several times if you need the information to sink in. I promise it gets easier over time. And I will catch you guys in the next video. Have a wonderful day. Take care. Bye-bye.